Watch this. What are government bonds 2022? How to utilize them. A government bond is a type of debt-based investment, where you loan money to a government in return for an agreed rate of interest. Governments use them to raise funds that can be spent on new projects or infrastructure, and investors can use them to get a set return paid at regular intervals. How do government bonds work? When you buy a government bond, you lend the government an agreed amount of money for an agreed period of time. In return, the government will pay you back a set level of interest at regular periods, known as the coupon. This makes bonds a fixed income asset. Once the bond expires, you'll get back to your original investment. The day on which you get your original investment back is called the maturity date. Different bonds will come with different maturity dates. You could buy a bond that matures in less than a year, or one that matures in 30 years or more. Government bond example. Say, for instance, that you invested 10,000 Australian dollars into a 10-year government bond with a 5% annual coupon. Each year, the government would pay you 5% of your 10,000 Australian dollars as interest, and at the maturity date they would give you back your original 10,000 Australian dollars. Types of government bond. The terminology surrounding bonds can make things appear much more complicated than they actually are. That's because each country that issues bonds uses different terms for them. UK government bonds, for example, are referred to as gilts. The maturity of each gilt is listed in the name, so a UK government bond that matures in 2 years is called a 2-year gilt. In the US, meanwhile, bonds are referred to as treasuries. Treasuries come in 3 broad categories, according to their maturity. Other countries will use different names for their bonds, so if you want to trade bonds from governments outside of the US or UK, it's a good idea to research each market individually. Index-linked bonds. You can also buy government bonds that don't have fixed coupons. Instead, the interest payments will move in line with inflation rates. In the UK these are called index-linked gilts, and the coupon moves with the UK Retail Prices Index, RPI. In the US, they are called Treasury Inflation Protected Securities, TIPS. Buying and selling government bonds. Just like shares, government bonds can be held as an investment or sold onto other traders on the open market. Using our above example, say that your 10-year bond is halfway to maturity, and that you've spotted a better investment elsewhere. You want to sell your bond to another investor, but because better investment opportunities have arisen, your 5% coupon now looks a lot less attractive. To make up the shortfall, you might sell your bond for less than the 10,000 Australian dollars you originally invested. An investor buying the bond would still get the same coupon rate minus 5% on 10,000 Australian dollars. But their yield would be higher, because they paid less to get the same return. A bond with a price that is equal to its face value is said to be trading at par. If its price drops below par, it is said to be trading at a discount, and if its price rises above par, it is trading at a premium. Which factors affect the prices of government bonds? Supply and demand. Just like any financial asset, government bond prices are dictated by supply and demand. The supply of government bonds is set by each government, who will issue new bonds as and when they are needed. Demand for bonds is dependent on whether the bond looks like an attractive investment. Interest rates can have a major impact on the demand for bonds. If interest rates are lower than the coupon rate on a bond, demand for that bond will rise as it represents a better investment. But if interest rates rise above the coupon rate of the bond, demand will drop. How close the bond is to maturity. Newly issued government bonds will always be priced with current interest rates in mind, meaning that they'll usually trade at or near their par value. And by the time a bond has reached maturity, it's just a payout of the original loan, meaning that a bond will move back towards its par value as it nears this point. The number of interest rate payments remaining before a bond matures will also have an impact on its price. Credit ratings. Government bonds are usually viewed as low-risk investments, because the likelihood of a government defaulting on its loan payment tends to be low. But defaults can still happen, and a riskier bond will usually trade at a lower price than a bond with lower risk and a similar interest rate. The main way of assessing the risk of a government defaulting is through its rating from the three main credit rating agencies, Standard & Poor's, Moody's and Fitch. Want to get paid to use social media? Click the link in the pinned comment to get started. Like, comment, share, subscribe and click the notification bell to get more content from us.